This week will be absolutely insane for Bitcoin because this is the second biggest driver that we discussed the last couple of days. It's Fed weekday, okay? And there's a saying on Wall Street, never fight the Fed. And this is very, very good if they cut to help the crypto prices to go higher. So let's dive into this video.
Welcome to the game, I'm the wolf of Dubai.
Welcome to a brand new video. If you don't know who I am, my name is Danny and I'm looking for stocks, specifically US stocks that can go 10, 20, 30, 40, 50x. I invested into Tesla when it was a $23 stock. It went down to 11. I didn't lose my head because I had my life savings in. No, I put even more an average down because I knew it's one of the most beautiful companies. And by then, it didn't look that great like it looks like now, okay? It looks like that the company is failing, bankruptcy, and so on. So if you consider then Bitcoin where it is right now, it is a pretty good deal. And then my subscribers and my followers, they bought houses and apartments in the US because they trusted what I was sharing here, my own due diligence. Obviously, make your own research, and your own research is so important because you never should only focus on one source of information because everyone has a different risk appetite, right? So make sure to do that. And also, if you want to, besides your long-term portfolio that I make totally for free here, to get also our short-term trading every single day in and out of trades, all automatically done for you because we wanted to create a solution where you don't have to do anything and we do all the rest with our whole day trading team. Then check out xtendaytrading.com because we want to achieve between 8 to 15% growth in your account. And if you start with $10,000, that compounded leads to around like $58,000 at the end of the first 12 months. Okay, so if this is interesting for you and you want to trade with us, then schedule a call with me personally and we see if we can help you as well. Now, let's dive into the big topic here in this upcoming week. Well, it's the Fed. On the 10th of December, the Fed will decide what the rates will be. And I feel that there's two things. First, we were so uncertain that the Fed will cut even in the first place. And then usually what happens on the market, there's a lot of Fed speakers from the committee and they are coming out and say like, hey, I think this and that. So with that information, we have seen that a lot of the Fed speakers actually said, you know what, an appropriate rate cut should happen in December as well, right? So with more and more of the Fed committee is saying that, obviously you have the rates, the probability of a Fed rate cut going higher and higher. Now it's at 85%. So there's two things, okay? The Fed usually does what the market wants to see and what the market expects to just not shock the market. So they most probably rate cut. Okay, if they don't, then this will be very bearish for the market. If they do, then this will be very bullish for the market because it just confirms. And I think that that's why the market is kind of waiting mode right now. And it's actually very good and bullish if the market thought there's no rate cut and then they're going to, kind of the probability goes higher because of the interviews, but then the rate cut really happened by the Fed. I think that can be very bullish. And why is that so bullish for Ethereum and for Bitcoin? That's what we dive into after a short clip where they talk on CNBC about this rate cuts and the Fed decision in this next coming of days.
Meantime, broader markets closing out the week with gains, but off their highs of the session. The S&P and Dow both less than 1% from records. The moves come after the latest read on inflation, a September reading delayed by the shutdown, came in about in line with expectations. All this ahead of this year's final Fed decision next week. For more, let's bring in Andrew Davis, Director of Macroeconomic Research at Bryn Mawr Trust Advisors. Andrew, great to have you with us.
Thanks for having me. Great to be here.
In terms of the Fed meeting, I don't know what you expect, and maybe it's more important to think out till next year. We're going to get a new Fed chair. We're going to sort of maybe have a shadow Fed. Things will be a lot different.
Yeah, I think that's the main thing. Look, for 2026, we're looking for a slow stretch expansion. We think that the Fed has a lot of optionality here, particularly with the productivity tailwinds that we're seeing. So I don't think it'll be too much of a surprise in this dot plot post-GFC world that we live in. Whatever's priced in going into the weekend, the Fed usually delivers. I expect that. But I do think that the dot plot might reveal some clues about what the committee's thinking as a whole. Ultimately, I think think predictability maybe comes back in 2026, maybe fits and starts, but the Fed becomes more predictable. And then that will allow earnings to drive the market, which is healthy.
I mean, in terms of the dot plot, it'll be interesting to see who is where, but it also may reveal in terms of when we get, sort of the readout, who is where in terms of divisions in the Fed. And so even if you have a Fed chair who is gung-ho on cutting interest rates, you may not have the committee backing that necessarily. So it feels like there could be more volatility that the market might not be pricing in next year.
Well, I think that the market will live with this meeting next week. I think that we all understand that the Fed is a consensus institution. So whoever you put in there is going to build consensus. The dot plots aren't promises, and I think that they'll be working towards neutral, towards 3% over time. And I think that would be constructive and healthy for the market.
So where do you think they're trying to get to?
Yeah, I think that they take one December, markets letting them do that. And then we see them cutting maybe in that April window, and then one more time and they're at neutral. We think neutral is right around 3%. So they're not too far off that. And I think that they're just incrementally going to maintain that bias.
Andrew, market breadth has actually, I think, been impressive over the last few weeks, and I think it sets up very nicely for 26, where I'm hearing a lot of the strategists from the street echo some of the same themes, but talk about some elements of where we're going to see earnings growth. I'm just curious what sectors you want to lean into, because banks look great. Consumer and retail has been very resilient, even for the K-shaped economy. We know tech. Where are you leaning?
Yeah, I agree, Tim. I think it's a healthy backdrop, particularly some of the wind that's come out of the sails around. I heard you all talking about Oracle. But look, I think that where we want to focus is this value down trade. The consumer is not a monolith, so it's definitely bifurcated. Earnings calls just this week reiterated that. Kroger saying middle income shoppers acting more like lower income at this point. So we want to look at value oriented plays. And then I think in the AI trade that we're moving towards incrementally stage 2. Out of the chips, maybe into the plumbing, into the picks and shovels. And so I think those are two areas that have our attention for 2026.
So as you can see, this is very important. What the guys are on CNBC saying, the Fed usually wants what the market wants as well. They don't want to shock the market, right? But why it's so important for Ethereum and for Bitcoin? Well, it's important because this is a very high risk asset class. Not only crypto is a very high asset class, that's why it's also very volatile, but also Bitcoin as a crypto related stock, it's very volatile by nature, but it's also very volatile and very, very risk on because it's a quite new company. It's a very high growth company. So because of that, the money, when it gets cheaper, it's actually very good for those risk assets, right? Because there's more and more money to be available for big investors. And then they say, okay, we put already enough in value stocks, like, or value asset classes, like let's say the S&P 500, Apple, right? All of this, let's say same bet, bond, right? But now we have that extra cash that we can get for much less in interest. We can get it from banks. We can get it as loans. We can get it as liquidity. And we just have to pay 2% instead of 4% or 3%, right? And soon, maybe you remember in 2019 or 2020, we had even 0%, right? So almost close to 0%. So that was like free money. And that they say, okay, the free money, now we can invest even more and more money comes to the market and market gets more liquid and everything goes higher. And specifically, that's why you saw those highs in crypto in 2020, for example, right? And also the risk asset companies like that just had barely any revenue or had ever, not even a product really, even not saying profit. They went through the roofs and had billions and billions of dollars of valuations, right? So that's quite interesting to see that with rates going down, this kind of phase might come again, right? Which is great to lock in into huge profits, Bitcoin at 500 and 1,000 and 2,000. But it also means that at some point when this happens again, I know what happened in 2020 and 2021, right? So that's the time when you take a little bit off the table some chips, right? So with that said, I hope that helps you to prepare for next week. And it's very, very important to watch the market on the 10th of December and what the Fed does. And with that said, let me know in the comments what you think. And I see you tomorrow for a brand new video because the grass is greener always on the other side.